Hi, I'm George Pino, the CEO of Commercial Brokers International. Wanted to discuss today the current market conditions, specifically on a submarket of Los Angeles, in the Westside submarket of Los Angeles, and really discuss over the year-over-year changes and forecasting expected changes over the next year, as well as talk about potentials for investments in the retail and multifamily sectors and what we see is happening currently in the market. Historically, they've typically been about a 12 to 15% vacancy rate. From last year, it was about 10%. Currently, we're at about a 9% vacancy rate, and we expect to absorb approximately 600,000 square feet more in the coming year, which should bring our vacancy rates to about 8%. Many of the Class A buildings in the area also are showing a vacancy rate that is lower, even lower, upwards of 3%, and in some cases 100% occupied. Office rents on the west side of Los Angeles have steadily gone up over the last year. Last year, about this time, they were averaging about $3.70 a square foot, currently about $4.15 a square foot, and which equates to about a 12% increase in rental rate for office buildings. I do expect that the rental rate will continue to rise as demand stays stable and inventory goes down as we absorb more properties in the coming year. A pocket area within the Westside Los Angeles market is, of course, the Silicon Beach submarket. Rates there have actually gone substantially higher than the 12% increase that we've seen year over year for the general office market. Part of that is due to demand, very low vacancy rates, and I see that as continuing to grow in that sector as well as far as rent growth. Retail vacancy rates don't really look good for tenants right now. We thought the vacancy and the market was pretty tight last year with a 5% vacancy rate. Currently, we're actually seeing about a 3% vacancy rate as demand has increased and inventory has pretty much remained stable. I see in the future with expected absorption that we're expecting over the next year that vacancy rates will decline a little bit, but not as much, probably about a 2.7% vacancy expected by this time next year. Well, of course, with the decrease in the vacancy rate, we've seen a corresponding increase in the rental rates, although not as high as what we've seen in the office market. Traditionally, last year, we were looking at about a $4.10 per square foot triple net rent for most of the retail on the west side of Los Angeles. Currently, it's about $4.50 a square foot triple net rent, and which equates to just about a 10% increase. Not quite, but close. I actually anticipate over the next year to see that increase up probably about the same, 8 to 10% over the next year, as we expect to have about an 83,000 square foot absorption, which is going to put down the vacancy rate down to about 2.7%. We're still pretty bullish on investors in the retail sector, especially in the west side of Los Angeles. Demand has never been higher for retail, and rents are increasing. So with the lack of inventory and high demand, we're still looking at a pretty good investment in the long run, with rental growth increasing, especially since the rental growth hasn't increased as much as the office sector. The multifamily vacancy rate within the west side of Los Angeles has remained fairly stable. Last year it was at a pretty healthy 3%, maybe slightly above that. Overall, current market's about a 2.7% vacancy. We don't see that changing that much over the next year. Cap rates also have remained fairly stable at about a 3.8% cap rate for multifamily properties on the west side of Los Angeles. The multifamily submarket within the west side of Los Angeles has always been high in demand for investors. However, it really hasn't seen as much of a rent growth as we've experienced in the other sectors of commercial real estate, looking at about a 5% rent growth year over year from last year, probably mainly attributable to, one, less people turning over and moving out so we can bring the rental rates up to market rate, and also with many of the properties being in a rent control submarket. We're not as bullish about the investments within the multifamily sector of the West Los Angeles market, primarily due to the fact that the cap rates already are at a fairly low 3.8%, and they really don't see them going down that much lower. And with the expected increase in mortgage rates, we're going to see a corresponding increase in the cap rates. Also, it's a little bit more difficult to raise the rents for multifamily properties, as we've seen with multifamily properties only seeing about a 5% increase year over year from last year.